Good afternoon, everyone. Welcome to our third quarter Market Insights webinar. Consistent with past versions of this series, we're here to explain to you what happened in the third quarter, as well as to provide some themes to watch for in the last quarter of the year. Now, before we get started, the usual housekeeping items. We're happy to answer any questions that are on your mind. We have received some questions prior to the beginning of today's webinar. We will address those first, but should you have further questions, please submit those using the Q&A feature. We have about 45 minutes of prepared remarks, and then the duration of the hour to answer a question. This webinar, like other ones, will be recorded and uploaded to our YouTube channel. It should be available shortly after the completion of today's live webinar. For introductions, my name is Greg Leonberger. For those of you who have listened to one of these before, hopefully I'm a familiar name and face at this point. I am the Director of Research here at Marquette. I will cover the U.S. economy as well as real assets. Frank Valli will review fixed income. Catherine Hillier and David Hernandez will cover U.S. and non-U.S. equities, respectively. Evan Fraser will take us through hedge funds. Then Michael Carlton and Haley McCollum will cover private markets, private equity, and then private credit in that order. We always start with the U.S. economy, and today's session is no different. The dominant theme over the last 2 or 2.5 years at this point has been inflation, and we're going to lead with that again today. And the good news is that inflation continues to trend towards the Fed's 2% long-term target. And while it seems to be normalizing a little bit above that target, it has settled into a range to the point that the Federal Reserve was comfortable enough to drop interest rates 50 basis points last month. Now, the question, of course, is where do we go from here? After the 50 basis point cut in September, the expectation initially was there would be a 25 basis point cut in November, then another 25 basis point cut in December. At this point, it looks like it will be one of those two, but not both. And Frank, when he covers the fixed income section, will cover that in a little bit more depth. In terms of the overall economic outlook, all signs point to a soft landing at this point. Now, I will not say that is the universal opinion of all economists out there, but the majority of economists do expect a soft landing in which the U.S. economy successfully avoids a recession. And if we look at long-term projections for the federal funds rate, GDP, unemployment, and inflation, these predictions support that thesis. The federal funds rate will settle in around 2.5%. GDP probably grows at about 2% year over year. The unemployment rate settles into that 4.5% range. And finally, inflation is around the Fed's long-term target of 2%. So certainly a glass half full look at economic projections and what the economy holds in store. Now, one other thing which we have not included a slide for here, but it is very much on people's minds, is the election, which takes place on Tuesday, November 5th. Long term, the winner of the election for both president as well as Congress is not expected to have a material impact one way or another on the direction of capital markets. We've shared that with all participants in the past, whether it be on this webinar series or in some of our written communications, and we still expect that to be the case. It is worth saying, however, though, that the results of the election will probably not be known on the evening of Tuesday, November 5th. The races are very close in some of the swing states with razor-thin margins. Because that, it will likely take a couple of days to determine the winner. It would not be surprising to see elevated volatility in those couple of days before the ultimate results of the election are known. At the end of the day, markets like certainty. Once they know the winner of the election, there'll be much more clarity on what some of those policies will look like, what the impact will be across the world. That's the U.S. economy. Now, we always move to fixed income next because there's a natural connection to the Federal Reserve policy and interest rates to the expectations of performance of fixed income. So with all that said, Frank, take us away on fixed income.
Thanks, Greg. So the good news was interest rates were lower in the third quarter, which is good for fixed income. So the Bloomberg aggregate was up 5.2% during the third quarter, and those positive returns were extended across fixed income markets. Year to date, the ag is up now 4.4% through September, and we've seen enhanced returns in some of the spreadier sectors because of the extra carry and spread tightening giving additional returns. So high yields up 8%, leveraged loans were up 6.6%, and EMD was up 8.6%. Now, we've actually given some of this back in October. We've seen a backup in rates, and month to date, the ag is down 2.1%. And this is really cut into year-to-date performance, with the year-to-date performance of the ag now down 2.3%. So as I mentioned earlier, that rates were down across the curve as the Fed finally started to cut rates here in September. So the bellwether 10-year note was down 61 basis points over the quarter. The 2-year note is a little bit more policy sensitive, so it's more sensitive to what the Fed does. And that note was down 11 basis points. Now, like I said, we gave some of this back. So here in October, we've seen the curve shift up about 40 to 50 basis points. So because short-term rates fell faster than some of the long-term rates, the 2-10 curve finally normalized. So after 783 days, we've now seen a situation where long-term rates are above short-term rates, and this ends the longest inversion in history. So as mentioned before, the Fed finally did cut rates here with the 50 basis point cut in September. There were additional rate cuts expected in November, December. This chart was taken at the end of the quarter, so they were expecting another 25 basis point cut in November, an additional 25 basis points in December. That's been tempered a little bit, and as Greg had mentioned, it's now probably one or the other. They're either going to do 25 in November and skip December, or 25 in December and from skipping November. So what does this mean for fixed income? So fixed income yields remain solid. Higher treasury yields have equated to higher yields across the fixed income spectrum. Most sectors are trading at or above long-term averages. So looking forward, I think we've got a reasonable idea of what you should expect. So over the long term, the starting yield is a good guide for what's going to happen in terms of fixed income returns. So it's reasonable to expect about a 4.2% return over the investment horizon. That's ticked up a little bit because rates are higher here in October, so it's about 4.6 today. However, over the short term, you can see some volatility. So going across the horizontal axis, that's how, if we saw a movement in spreads, what we should expect for that year over a 1-year horizon. On the vertical axis is what happens with treasury rates. So if treasury rates go up and down, what would happen? And what we see is over most markets, you're going to see positive returns. And that's because we're in a lot different situation than we were in 2022, because the starting yields are at a much higher level. So while yields are good, spreads are bad. Yield buyers have really kept a lid on spreads. So high yield is now trading about 200 basis points inside of historical averages, and long credit spreads touched 100 basis points over treasuries. In the recent futures, about 125 to 130 basis points over treasuries was considered tight. Now we're trading well inside that. But one area that there is still some value is the area of securitized. Securitized covers two broad areas. The first one is mortgages. That contains both residential and commercial mortgages. And the other one is asset-backed securities. Some of those are levered to companies like CLOs, and some are more consumer-based like ABS. Regardless of whether we're looking at mortgages or asset-backed, they're trading a little bit wider, especially and offer a good relative value to corporate credit. So just to wrap up, what are the strengths and opportunities we see in the market? The first is bonds are still back. The great interest rate reset made bonds attractive again. Starting yields are around 4.5%. That's a reasonable assumption for long-term returns. It's unlikely that we're going to see negative total returns over the next year. One area we didn't spend a lot of time talking about is investment-grade corporate bonds. Yes, investment-grade corporate bonds are tight, but they're tight for a reason. That sector has really good fundamentals. A lot of those companies termed out their debt, so they're in a good spot. And that additional risk by taking that corporate credit risk is a source of additional carry, which could be positive for your portfolios. And then finally, the area that we do see some value is that within securitized, they're giving you a better return potential than some of those corporates. Areas that we see risk. The first one is going to be Fed policy errors. While the market is predicting a soft landing, we also think a soft landing is most likely outcome. There are some tail risks. The first one is the Fed cut too early. When they cut in September, if they did that too early, inflation could spike, which could lead to raising Fed funds and could cause some issues. The other side is that they cut too late. They kept policy restrictive too long, unemployment spikes, and that puts us into recession. If you do see that recession, that puts us into our second risk, and that's an economic downturn. Because spreads are so tight, if you do see a downturn, spreads could widen significantly. And then the final risk that's in the market is just the number of wild cards that are out there. There's the U.S. election that's going to be settled here in the next 10 to 15 days, and then two ongoing wars. The Middle East sees signs of increasing aggression, and then there's just the continuation of the Russia-Ukraine war that's been going on for 2+ years now.
Thanks, Frank. And after the end of the third quarter, fixed income seemed to be purely a positive story, and we've definitely seen a little bit of a step back in returns the first couple of weeks here of the fourth quarter, but fixed income is still positive for the year. And the good news about yields going higher is that for investors putting more into fixed income today, the yield is higher, and the expected return should be higher as well. All right, that's fixed income. Let's move to equities now. We're going to cover U.S. and non-U.S. As usual, a lot of moving pieces, some of the same headlines, a few things to watch for in the coming quarter, which we haven't spent too much time talking about in the past. So, Catherine, why don't you tell us what you're seeing for U.S. equities, and then we'll pass it to David for non-U.S. equities.
Yeah, thanks, Greg. If you look at performance for U.S. equities for the third quarter, on the surface, it looks like value and small cap equities had a dominant 3 months, as the Russell 2000 outpaced the S&P 500 by nearly 3.5%, and value equities also led their growth counterparts. This suggests a long-awaited broadening out of the market, but this narrative seems to have started to break down as you look under the surface. Following the first monthly inflation rate decline in years in mid-July, expectations for a shift in Fed policy drove a small cap equity rally, with the Russell 2000 advancing over 10% in just the month of July alone. As this euphoria wore off, though, small cap equities actually declined 80 basis points in the last 2 months of the quarter. From a style perspective, growth equities reasserted their dominance in September, as we'll discuss on a subsequent slide, as the story of the Magnificent Seven continues to drive part of the narrative for the U.S. equity market. From a sector perspective, one of the stories for the quarter was utilities. Although we have spoken about artificial intelligence and the benefits for companies in both the information technology and communication services sectors, utilities emerged as another way for investors to gain exposure to this theme, primarily through the build-out of data centers and the increased demands on the electrical grid. These secular tailwinds supported a near 20% gain for the utility sector in the third quarter. On the previous slide, we highlighted the outperformance of value equities, so it may not come as a surprise, as interest rate sensitive sectors also led the market in the third quarter, namely the real estate and financial sectors. So one of the key events that's already been mentioned in the third quarter was the first interest rate cut by the Fed, following months of market speculation. As shown in this chart, in periods not followed by a recession, this tends to be very positive for equity markets, with double-digit returns in most of the subsequent 12-month periods for both large cap and small cap equities. This may rhyme with what we're seeing today, as the Fed's decision to cut rates in September was made as growth remains strong, the inflation is cooling, and the labor market appears somewhat stable. But it's worth suggesting that this may look different this time, or at least not as euphoric as we've seen in the past. The S&P 500 has advanced over 26% in 2023 and is up over 22% through September, which makes it hard to fathom a further double-digit return in the next 12 months, especially as valuations for U.S. equities sit near historic highs. But as we'll see on the next slide, U.S. equity markets continue to show surprising resilience. So despite some mixed economic data, the S&P 500 has marched upward in 2024, achieving yet another all-time high to close September. Strong earnings growth, largely among the Magnificent Seven companies, once again is a key contributor to this phenomenon. We'll touch on this dynamic a little bit more in the subsequent slides, but looking at the third quarter, volatility did emerge as cracks in the job market appeared. Alongside cooling inflation, this helped support the decision to cut interest rates by 50 basis points in September, with the job market becoming a bit of a bigger concern for the Fed. Interestingly, investors may think that an interest rate cut would be more supportive of small cap equities, as these companies typically carry higher debt burdens, which makes them more sensitive to the higher rate environment we've been in. From this chart, however, the reaction was fairly muted for the Russell 2000, especially relative to the S&P 500, which does pose the question of how much has already been priced into the market. And through Monday, the Russell 2000 has advanced just 1.5% since this rate cut in September, while the S&P 500 has already advanced over 4%. Although telling the story of the Magnificent Seven seems a bit overdone at this point, as we've been talking about it since the beginning of 2023, it does remain an overriding theme for U.S. equities. In the third quarter, the hope that markets would broaden out took hold in July, which is a welcome reprieve for many active managers. You could point to the S&P 500 equal weighted index as evidence of this, as it advanced 9.6% in the third quarter, besting the 5.9% return for the market cap weighted S&P. Similar to the story for small cap equity outperformance, however, this was largely attributed to July. By the end of the quarter, confidence that this narrative would persist waned, as the Magnificent Seven companies contributed over 50% of the S&P 500 return in September, as we can see on the chart. On the next slide, we'll see how earnings growth continues to support the performance for these select companies. So a couple of quarters ago, we shared a slide that forecasted a decline in earnings expectations for the Magnificent Seven companies, with a subsequent improvement in expectations for the remainder of the companies in the S&P 500. With these forecasts, the earnings growth differential between the Magnificent Seven companies and the rest of the S&P 500, was expected to narrow pretty significantly. As earnings play a critical role in market performance, this narrative would support a persistent broadening out of the markets, which many investors have been waiting for. But as we see here, based on revised estimates, earnings growth for the Magnificent Seven companies is expected to be better than predicted, while the rest of the companies in the S&P 500 may not be as strong as was originally forecasted with our 630 forecast. This dynamic may dampen market breadth, as we saw that to close the quarter, as the Magnificent Seven companies did contribute over 50% to the S&P 500 return. There we go. So if we focus on the risks and opportunities in U.S. equities, many of these may seem familiar, and we won't touch on some of the ones that Frank's already mentioned. So we have discussed the revival in small cap equities in the past, and this story continues to gather support as the fundamental backdrop for small cap equities continues to show signs of improvement. The Federal Reserve policy becomes a little bit more accommodative, and forward valuations for small cap equities remain near historic lows relative to their large cap counterparts. But with that said, the continued market volatility expected through the end of the year, it's really difficult to say if or when market leadership may shift away from these large cap companies, as they continue to post strong earnings growth and have been perceived as a sort of safe haven for the market. It is still worth noting on the risk side of the equation, however, that some of these companies do have lofty expectations baked into their current valuations. So the stock prices for some of these companies may see increased volatility. This happened with NVIDIA in the third quarter, as it sold off after falling short of the loftiest of earnings expectations, but since then it has also achieved new highs in November. So to conclude for U.S. equities, although we still believe the backdrop remains positive given the expectations we have for a broadening out of earnings growth and constructive economic data, following significant market strength since the start of 2023, the returns we see going forward may be a bit more muted than what we've seen over the last several quarters.
Thanks, Catherine. That point bears repeating. At the end of the day, we hold these webinars for our clients to help formulate and manage expectations. And the reality is it's just not a sustainable upward march of 20+% year after year after year in the equity markets. So it's not unrealistic to expect more subdued returns in the coming quarter, perhaps even over the course of 2025. So that said, let's move over to non-U.S. equities, and David, at least one new headline this past quarter with China's September performance. But what else are you seeing?
Well, really, across the board, all non-U.S. equity benchmarks generated a positive return in the third quarter. And that brought year-to-date performance to double digits, which is a pretty good year for 2024. You have developed small cap stocks posted the strongest third quarter, returning 10.5%. September, as we said, was also friendly to emerging markets, which posted a 6.7% return that month. We had big stimulus news from China, and that pushed that asset class higher. I'll talk more about China, what happened in September, and importantly, whether we think their returns are sustainable in the coming quarters. But first, let's talk about currency. This was a key tailwind for non-U.S. equities in the third quarter. Currency added 6.4% in developed markets and 2.1% in emerging markets. Now, if we look at the last 15 months, we've seen currencies move up and down largely based on central bank expectations in the United States as well as other parts of the world. We go back last year to the third quarter of 2023, currencies detracted. And then to end 2023, they rallied. And then they fell in 2024 to start, and then they rallied in the third quarter of this year. Now, given the uncertainty around future Fed actions, I think it's likely to see continued fluctuations in currency movements over the next several quarters. And the uncertainty really is not just present domestically, but it's also present outside the United States. Japan in particular has seen large movements in the yen, with leadership sending mixed messages on interest rate expectations. At the end of September, you had a surprise election result with the new prime minister winning and is someone that favors a normalization of interest rates. As a result, in the third quarter, the yen returned 12% versus the dollar, and this was the biggest quarterly appreciation in over 15 years. Now, we expect continued fluctuations in currencies, with markets attempting to anticipate monetary policy from central banks throughout the globe. Now, looking at equity performance throughout the globe, I think there's some interesting trends that we've seen emerge in 2024. Firstly, after strong performance in 2023, Brazil and Mexico have each had considerable pullbacks this year. Fiscal policy concerns have plagued both countries, though we did see Brazil rally in the third quarter. Two Asian markets, India and Taiwan, they continue to be at the top of the list in terms of country performers. Taiwan's benefiting from AI and technology themes, and India has been benefiting from a robust outlook, both around infrastructure spending as well as future economic growth potential. And this quarter, we had a new entry into the top 3 country performers year to date through 2024, and that new entry is China. So let's spend a little bit on talking about what happened in China and whether we think it's sustainable or not. Now, for most of the last year and a half, China has underperformed the rest of the emerging markets and really has underperformed most of the rest of the world. In September, however, China was up 23.9%, just 1 month, 23.9%. And in September, China announced a list of stimulus measures that caught investors by surprise, and that pushed equity returns higher. Now, these measures included cuts to reserve requirements, cuts to repo rates. They also had some measures that were directed specifically at the property sector, as well as the local equity market. As a result of this news, there was a sharp rally, and many of the stocks that had been laggards in China became leaders in September. For example, the highest beta stocks, this group of stocks was down 21.8% year to date through August. In September, that same group of stocks returned 45.4%. So this was a dramatic shift in performance, both at the country level, with China rebounding significantly, and then at the stock level, with the stocks within China, what stocks became leaders in September. As a result, active managers broadly were caught off guard, leading to some underperformance relative to the benchmark in the third quarter. Now, this isn't the first time that we've seen a sharp rally from China over the last 3 years. If we go back to November 2022, Chinese equities were up 29.7%. If you go back to July 2023, China was up 10.8%. Neither of those times led to sustained returns. There was some continued struggles within Chinese equities over the last 3 years. We think that there are 2 key things to look at, to focus on in regards to the question on sustained performance from here. The first is company earnings, and the second is consumer confidence. Now, company earnings over the last several quarters has been disappointing, and if we look at the outlook from today, the outlook is also poor. If we look at consumer confidence, that has also been disappointing, and it hasn't rebounded since the lows of 2022. So I think the key question is, will these stimulus measures, and really any additional stimulus measures that the Chinese government comes out with, will these stimulus measures boost the company and consumer outlook? And I think that it's fair to be skeptical that that will happen at this point in time, and to be skeptical about the return performance, sustainability of the returns going forward from here. Now, we've had 3 charts on China, so let's talk about developed markets next before we wrap up. Some other news that came out last Thursday, the European Central Bank announced a 0.25 point interest rate reduction to 3.25%. This is the third cut in 2024, and this is the first back-to-back interest rate cut in 13 years. So why did the ECB cut? One of the big reasons in September, Eurozone inflation fell to 1.8%, and this is below the 2% target. You also had key economic survey data that fell. In particular, composite PMI moved into economic contraction territory. So there seems to be a shift from the ECB in from a focus of trying to control inflation, which currently looks to be controlled, to trying to slow a slowing economy, or better said, to boost economic growth in the Eurozone. Let's wrap things up on the non-U.S. equities section with opportunities and risk. The slower economic environment in Europe is certainly a risk. We've talked about geopolitical uncertainty already with the conflicts in the Middle East, as well as elections in the United States and the potential tariffs that may happen that will have an impact on the downward side to global economic growth. We also talked about China. There's been some recent stock volatility. Yes, it was up in September, but if you look at October, it's down about 4% through Monday. Some big swings in performance that can introduce some tough timing decisions from an allocation and stock perspective. So we think that is a key risk. Opportunity-wise, we think EMX China continues to be attractive. We've talked about India and Taiwan as being interesting markets. And then Japan, despite some of the currency volatility, earnings growth is trending in the right direction, and you continue to see improvements around corporate governance in that market.
Thank you, David. And it sounds like the China rally in September, while good for investors, may not be sustainable long term. And then in terms of opportunities, something we've talked about really for the better part of the year of EM beyond China and seeing some really promising stories there. Let's transition now out of the traditional asset classes and into alternative asset classes. And Evan, you can lead us off with hedge funds.
Yes, thank you, Greg. We'll take a look here at hedge fund performance through the end of September. And we can see that pretty much every one of these strategy types that we have listed on the page continued to post gains in the third quarter. So the put right index continues to lead the way after about a 5.5% return in 3Q. This has been a theme that we've talked about for a while now. There's a lot more equity beta embedded in those types of strategies. So as markets are going up, put right strategies should capture anywhere from 50% to 70% of that gain. Equity-oriented strategies obviously have also done well this year. You can see the equity hedge index up around 10%. Again, not surprising given the higher levels of directionality there. Maybe a couple of other things to point out here. So the first being event-driven, 5% or so return in 3Q, really good number there. Merger arb, we've detailed some of the challenges facing that space in recent time on recent webinars, but you can see an almost 4% return for merger arb in the third quarter. I think there's a bit more optimism surrounding the deal making and corporate event landscapes now than in quarters and years past. And then finally, global macro. So macro strategies, you'll recall, had a hot start to the year. Macro was up about 7% in 1Q. They've since kind of come back down to earth. You can see the negative 1% or so return there in the third quarter. So certainly that year-to-date figure of 4.5% looks a lot more lackluster, shall we say, relative to some of these other indices. So despite that, I guess blemish from macro hedge funds, fairly solid in 3Q and continue to perform well on a year-to-date basis. So it's been a good year for long-short alpha generation, with the top 50 crowded long positions outperforming the S&P. Which is in turn outperforming the top 50 crowded shorts since the start of 2024. So alpha is being generated on both sides of hedge fund books, both long and short. It's actually interesting. So short alpha, which again has been challenged in years past, accounts for around 80% of the total alpha that long short funds have been able to generate on a year-to-date basis. And the 10 or 11% spread between the longs and the shorts through the end of September is the strongest such figure we've seen in the last decade and a half. So the crowded longs did give back some gains to start the third quarter, as you can kind of see on the chart, but the last few weeks have seen some stronger relative performance from that basket of stocks. So all good there. So I thought it might be helpful to run through kind of a high level theme or two related to hedge fund positioning, and we'll start with China. I'll maybe reiterate a couple of things that Dave said so eloquently a moment ago. So you can see hedge funds here were kind of piling into Chinese stocks in September. at levels not seen in about 4 years. And this buying, kind of helped fuel that strong rally in Chinese equities last month that Dave talked about. A rally, in fact, that was so strong that a lot of quant hedge funds that had taken some short positions in Chinese stocks have been met with margin calls in recent time. And like Dave said, those stocks have since kind of fallen back down to earth over the last couple of weeks. But it is interesting to see fund managers, maybe more so optimistic about the prospects of China, at least now relative to recent time. So we're going to stay in the Asia Pac region and look at hedge fund positioning related to the Japanese yen. Obviously, that was a very volatile currency in 3Q. Dave kind of talked about this, but the yen began the quarter at multi-year lows relative to the dollar. And then in late July, the BOJ decided to end its negative rate policy and raise its policy rate to 25 bips. So certainly not the 5% figure that we've been seeing here in the States, but still enough to catch a lot of investors off guard, many of whom expected the BOJ to hold policy steady. And in the days after that decision, we saw the yen strengthen, and we saw an unwinding of a carry trade wherein investors were borrowing in the yen and investing in some higher yielding assets. Since that time, we have seen the yen moderate somewhat, and it still sits close to historic lows relative to the dollar, with a conversion ratio of about 1 to 150. So where do traders and hedge funds see the yen going from here? Well, hedge funds are now, I guess, less bearish on the yen than they've been in the last 4 years or so. And you can see that in the number of net contract positions currently held in the market. So should we ultimately get that stronger yen, that could be a tailwind, again, not just for those funds that have this trade on, but also for U.S. investors in Japanese stocks because of that currency translation effect. And then the last thing on positioning would just be the extent to which funds have reduced net exposures to commodities like oil in recent months. Here we can see that investors are most bearish or least bullish on Brent crude, specifically in more than 15 years. Right now, crude trades at about $73, $74 a barrel. Does seem a little low given tensions in the Middle East that have obviously been escalating over the last year or so. I think some of the big reasons for the challenges that oil has faced in recent time have more to do with the demand side. So circling back to China, they're a top oil importer on the global stage, but given obviously weakness in their economy, they've dialed back their output in recent months. And then OPEC is said to have additional production capacity. So I think these factors are working to keep oil prices down, which obviously is good for funds that are more bearish on oil. Now that said, should we get more of a flare up in those conflicts in the Middle East, or we see demand start to normalize or increase, we could get higher commodity prices in the near term. Excuse me. So let's summarize the risks and opportunities facing the hedge fund space, and we'll start as always with the risks. So I talked about yen and oil positioning, the higher levels of China exposure. There's, of course, potential for strong performance as a result of these trades, but things like currencies, commodities, EM equities, they can be some of the more challenging spaces in which to forecast returns. Certainly macroeconomic and geopolitical factors play more of a role in those spaces. And as we all know, there's a lot more to be wary there. So that's one potential risk. Another one that I'll call out, just sort of lack of confidence in hedge funds. We've detailed this in prior webinars. It's been a tough fundraising environment for these types of strategies. So U.S. managers, U.S. hedge funds have seen net inflows of just $5 billion in the last 10 years. And that lack of growth can make it harder for funds to attract and retain talent, as well as build out the infrastructure necessary for alpha generation. And then on the bright side, in terms of the opportunities, this, again, we've talked about this, not necessarily unique to hedge funds, but the outcome of the elections here in the U.S. Should provide fund managers with some clarity related to the future of policy in this country, both at the micro and macro levels. That could make security selection a little easier. We have here the return of deal making. I talked about how event-driven, specifically merger arb strategies did well in 3Q. I think there are a few catalysts for continued positive performance from those types of strategies going forward. So the election is likely to be an inflection point in the regulatory backdrop and may lead to a shakeup at the FTC, which has certainly been aggressive when it comes to challenging deals and has contributed to inflated deal spreads in recent years. We're also set to get a couple of antitrust trial decisions for a few high-profile transactions this quarter. So while those spreads remain wide, maybe some light at the end of the tunnel for merger arb, and then the potential for the return of index level volatility. So folks will remember I talked about kind of that carry trade unwind that sent markets into a bit of a tizzy in August. We talked, or I guess spoke about the VIX spike up to I think 60 or so for the first time in years. Again, I think a lot of catalysts for higher levels of vol going forward. And if we do see those higher levels of vol, that could be a tailwind for strategies like VRP and relative value, even some equity managers as well. Volatility tends to be good for hedge funds, at least on a relative basis. And then finally, just a value prop for hedge funds, diversification, stable patterns of performance, flexible mandates, et cetera. It's been a solid first 9 months of the year for the asset class, and here's hoping for a strong end to the year as well and beyond. So Greg, I'll turn it back over to you.
Thanks, Evan. And the point about a solid first 3 quarters of the year is worth repeating. That it's really been a good run for hedge funds, and Evan talked about delivering on the value proposition. They are very much doing that. Let's move now to real assets, and yours truly is going to take you through both real estate and infrastructure. Now, the numbers on here on real estate, the return numbers for real estate, infrastructure, and then private markets as well, they're all lagged. We don't have third quarter numbers in yet, at least final third quarter numbers, but preliminary numbers are in for real estate. And it's a much better story to tell than what we've been sharing for the better part of the last 2 years. And the good news is that returns are positive. Now, they're very, very slightly positive, but they are above zero. On a gross basis, the index returned 25 basis points, and that's comprised of 1.05% of income, then about 80 points of price depreciation, right? So that nets out to 25 basis points on a gross basis. Then the net return is slightly positive. Of course, this isn't anything to jump for joy about on an absolute basis, but directionally, it's now positive, and we haven't been able to say that, like I said, for the better part of the last 2 years. We think real estate will continue on this positive trajectory. It's not going to be overnight. It's not going to be flip a switch back to the days of 8-9% per year, but it's going to be a slow climb. And one of the reasons we're seeing a rebound is what's happening to financing costs. And if we could look back towards April, really kind of looking at a number of different measures here, financing costs are down about 70 basis points. And then not surprisingly, that has spurred more activity, particularly in the multifamily and industrial spaces. These tend to be the largest allocations in most core funds. As you see more transaction activity, that bodes well for the overall space as managers are able to transact on some properties, either sell some properties out of their portfolio or add to their portfolio with attractively priced portfolio properties. So we think this is a really good sign. In more broadly, as we think about risks and opportunities across the core space in real estate, this is really one of the tailwinds that we're seeing right now of improvement in deal flow. And then the other one I'll point to here is fewer construction starts. And this may be a little bit surprising or counterintuitive, but the reality is as there are less construction starts, that's going to reduce the amount of new supply to be absorbed into the marketplace, which should help strengthen and even improve prices for existing properties. And of course, that translates well to investors across the real estate space. In terms of risks, it's really the same stories we've been talking about, right? The office sector, there's no real end in sight for some of the headwinds that the office sector is going through, though I do think the majority of write-downs have already taken place for funds as it relates to their office holdings. And the other point worth mentioning is constraints on manager flexibilities. So some funds which have very long redemption queues or really high amounts of outstanding debt on some of these properties are constrained in terms of being able to take advantage of some attractive prices in the marketplace for certain properties. So this is a manager by manager basis and not a constant theme for every strategy out there. But again, it's important to understand what this looks like for each manager in the core space. Now, if we talk about infrastructure, again, the returns here are lagged. The pattern here continues to be positive, both on a shorter, well, at least on a longer term basis, a little bit of a step back for some of the indices in the second quarter. But by and large, they were modestly positive in the second quarter of 2024. And more importantly, what are some new themes we're seeing in the space? And one of them relates to AI. Certainly the demand and explosion of AI over the last couple of years, combined with a projected demand for AI as we look out through 2028, it's really an astonishing growth number that's out there on these projections. And of course, what's needed to support AI is data centers. And as such, you see a real jump up in data center demand as well, both in terms of percentage growth as well as dollar amount and dollar amount invested. Now, of course, infrastructure funds are investing in these data centers, funding these data centers, the construction of these data centers. So as that goes, that should be another tailwind for infrastructure. Now, that's probably of these risks and opportunities that we've talked about over the years. That's really the newest story in terms of opportunities. And for risks, we've had this in here for most of this year about the election. As been mentioned by several other speakers, depending upon the results of the election, policies will look different based upon who wins Congress as well as the White House. And infrastructure could very much be exposed to some of those changes in policies. It could be accretive. It could be dilutive. That's something to watch as we move forward here. So let's move now to private equity. And Michael, take us through what you're seeing in private equity.
Thanks, Greg. This chart here shows performance through June 30, and we can see that private equity continues to lag the ACWI, S&P 500, and Russell 3000 year to date. Venture capital has struggled in particular with negative performance on the year, as portfolio company exits have been few and far between. While the private indices look comparatively better over 5 and 10-year timeframes, the meaningful run-up in public equities over the last couple of years has had a substantial impact on even the longer-term returns shown in this table. Here we can see that public market equivalents have now surpassed median U.S. PE for a number of recent vintage years, again due to recent public outperformance. However, it's important to note that top quartile managers have still outperformed public benchmarks across all 15 vintage years shown in this table. The importance of choosing best-in-class managers in private equity remains critical. Further, while recent private market performance leaves something to be desired, the inventory gap between public and privately owned companies continues to grow. In part due to the substantial institutional investment that has moved into the private markets, private companies raise more capital and wait longer to IPO. More of the economy's value creation occurring in the private markets underscores the importance of private markets exposure for investors. Exit activity has shown increased strength, with 2024 exit value on pace to surpass both 2022 and 2023. Corporate and sponsor acquisitions have driven the lion's share of these exits, with public listings still lagging historical trends. But USP inventory has also increased by over 2,400 companies since 2018. So while the uptick in exit value is encouraging, it has not yet caught up with deployment. EBITDA multiples on deals have been skewed by larger take-private deals, but here we can see that enterprise value to revenue multiples have fallen in line with historical averages for the smaller deals. This normalization of valuations should bode well for increased deal-making and exit activity in the quarters ahead, particularly as lower rates create more favorable financing. And lastly, I'll touch on VC here. So VC fundraising is on pace to surpass 2023, and in terms of total capital raise, looks strong compared even to pre-pandemic levels. But notably, fundraising has been somewhat bifurcated, with well-established managers raising larger funds and many emerging managers struggling to raise capital at all. LPs remain capital constrained due to the lack of distributions, resulting in less recycling of capital back into new vintages. Until IPO markets make a comeback and generate exits for VC managers, some fundraising struggles may continue. And to wrap up here, I'll cover some high-level risks and opportunities. So starting with risks, middle market PE has had relatively strong fundraising due to high financing costs pushing LPs towards smaller funds and deals. But as rates come down, this relative advantage may disappear. And then, as mentioned previously, the subdued IPO market could continue to create liquidity issues, particularly for VC managers. On the opportunity side, the Fed's rate cuts have already lowered financing costs and should continue to do so, creating favorable deal dynamics moving ahead. And finally, growth equity and expansion deals have seen a meaningful resurgence in 2024, which is a positive sign for early-stage venture companies as they look to raise additional capital.
Thanks, Michael. And similar to the story we told in real estate, as rates come down, I think the expectation is fair that we will see more deals and more transaction. Perhaps this even extends into the IPO market. That won't be an overnight trend, but over the longer term, let's call it the next 12 to 18 months, perhaps we see a little more pickup in the IPO market. All right, Haley, you get to take us home on private credit. All yours.
Private credit performance continues to take advantage of the elevated base rates to deliver strong performance. So private credit, which includes senior, mezz, and distressed investing, was up 2.1% in Q2 and 9.2% on a trailing one-year basis. Now, middle market direct lending, which is more applicable to where most of our clients have their exposure, this performed better. So this was up 2.6% in Q2 and 12.3% on a trailing one-year basis. In general, private credit has provided value to portfolios, typically as the first or second best of the asset classes within fixed income-oriented indices as shown here. The worst calendar year was in 2008, where anything credit or equity risk was down, and relative to high yield and leveraged loans, private credit still held up well, down 6.5% versus high yield and leveraged loans, which were down more than 25%. After slow deployment years in 22 and 23, we've seen loan activity surge to record levels in 2024. Now, this data accounts for all institutional loan activity, so it includes both syndicated loans and private credit, but the trends are relevant to both areas of the loan market. While activity is at record levels, you'll see that this activity is mostly driven by repricing and refinancing of existing loans opposed to LBOs and M&A activity. That said, you can look at the dark blue bar, and this shows that non-refinancing issuance, which is largely a proxy for M&A activity, and 2024 activity is certainly off the lows of 22 and 23. We'd expect this to increase over time as rates come down and private equity sponsors sell the businesses that they've been holding on to for extended periods of time. Now for defaults, we've started to see defaults tick up slightly in recent quarters within private credit. However, defaults still remain fairly low compared to historic levels. Compared to leveraged loans, private credit defaults are now slightly higher than more liquid leveraged loans. However, this is slightly misleading as most loans that come to, under stress will go through a distress exchange, so they won't be picked up as a default by definition in the data. The reality is that if they were in the private markets, it would show up as a default. So when you factor that in for leveraged loans, the defaults by broader definition are nearly 2 times what we've seen in private credit. All that being said, defaults are still in line with expectations given the elevated rates and higher fixed charge costs for borrowers. Now for the opportunities and risks. So obviously the Fed has begun to cut rates, but we expect this to be a slow path to lower rates, and private credit will continue to benefit from elevated all-in yields. Now the lower rates will also relieve some of the pressure on borrowers that have been trying to navigate the significantly more expensive debt burdens over the past 2 years, meaning the underlying credit quality should improve as rates fall in most cases. We're seeing more activity this year, but most of this is repricing existing debt versus M&A. We continue to hear that there's significant pent-up deal volume that needs to get done, so we're monitoring this post-election and into 2025. Now for the risks. So competition has led to less protections in place, particularly in the upper middle market, where we could see potentially some increased defaults. Now, additionally, while interest rates are coming down, it's going to take time to see this flow through as SOFR rates and loan docs typically reset after a quarter or semi-annually. So it's going to take a while for them to feel the relief of lower rates.
Thanks, Haley. Let's move now to the Q&A session of this afternoon's webinar. As I mentioned, we've gotten a couple of questions that have come in ahead of time, so we're going to go through those in order. Then if we have time left over, we'll cover anything else that has been dropped into the Q&A section. So let's start with hedge funds, and Evan, this is for you. How are hedge funds positioned from a sector perspective?
Yeah, so lately there's been a clear bias on the part of hedge funds toward more defensive sectors over cyclicals. So think real estate, staples, healthcare over spaces like discretionary, energy, and industrials. That's despite the recent jumbo cut from the Fed causing cyclicals to rally. And then tech, which we talk about a lot, that was actually the most net sold sector in September. And September marked the 5th consecutive month of tech selling. And that's the longest stretch of tech selling in over 2 years, and only the 4th time in history we've seen the sector net sold in 5 consecutive months, and now net exposure to tech has fallen to the lowest level in a year due to those continued outflows. So certainly some interesting dynamics at play within hedge funds from a sector perspective.
Michael, this is something that has come up from time to time as we go out and talk to clients. Should investors be concerned about the high level of dry powder in private equity?
Yeah, so even though dry powder has been shrinking in recent quarters, it's still well above historical averages. And this is putting pressure on deal activity to continue to show signs of further recovery. So definitely a potential cause for concern. But given that much of the dry powder is concentrated at the upper end of the market, we think that the lower middle market continues to offer an attractive opportunity set and could even bode well for lower middle market companies that are looking to exit to the upper market.
David, why don't you consider the rally in China as an opportunity?
Well, we did debate this internally on the team and think about whether or not to market as an opportunity. I think if you go back to September when the news was announced, you had a lot of positive news. And the thing is, the news was across several different stimulus measures. So it was very well coordinated by the leadership in China. There was a big reaction there. You saw a lot of buying from retail investors in China. Evan had that nice chart on hedge funds in terms of some of the dramatic shifts that we saw into buying into China. And so it was very easy to get excited about that and consider that as an opportunity. But ultimately, where we came back to was this idea around earnings growth not coming through within China and really lagging much of the rest of the world over the last 3 years. And then the consumer also not coming back. And until we see signs of that improving, we're kind of hesitant to mark China as kind of an opportunity market from here.
Haley, there's a question about PIK interest, and I'll just spell out the acronym in case people aren't familiar. It's payment in kind. So what implications does the rising trend of payment in kind interest mean for portfolios in the private credit world?
So it used to be an indicator of deteriorating credit quality or stress, but that's not necessarily the case now, as we see it entering into deals like on the onset in the upper market. So not the same as it was before.
All right, and then we're going to have Catherine and Frank both chime in on this. We'll let Catherine go first. How are you thinking about the election and then by extension, potential election results and the impact on your respective asset classes? Catherine, you can go first.
Yeah, I think with the equity markets, you've seen more volatility going into the election because there's a lot of uncertainty about policy coming out of the election based on who winds up being elected in November. But then as that volatility calms down to end the year, you can sometimes see a nice tick up in markets. With that said, the markets are already up. I think it was 1.7% or so through the beginning of the week, just in October, and that's pretty high relative to historical ranges. Within the fourth quarter of an election year. So any future uptick might be a little bit more muted again, as we've said with several things across this webinar. And then also just to say over the long term, the election tends to not have as much of an impact on the market.
Frank, how about from a fixed income perspective?
Yeah, so I mean, I agree. I mean, over the long term, what happens in the election doesn't really matter to markets, fixed income or otherwise. But one thing I will say, regardless of a Democrat or Republican gets elected, we're going to see more and more either more spending or less taxes. Either way, you're going to see the deficit grow. And eventually you got to pay the piper. So if you want to dance, you got to pay the piper. And that should mean higher back end rates.
And especially as we think towards the end of 2024 and into 2025, the deficit and the interest expense needed to cover that growing deficit will certainly be one of the themes we talk about going into the year. And it also bears worth repeating, and there's a letter going out tomorrow to our clients that addresses this, that who subscribe to the quarterly letter, that at the end of the day, the markets don't really care who wins the election, and results are really kind of agnostic relative to who is in the White House and who is in Congress. Now that gets us to the end of this afternoon's webinar. We'd like to thank you for spending the better part of the last hour with us. We hope it's been insightful and helpful as you think about not only the rest of this year, but going into 2025 and what you want to do. So anyways, thank you very much. We hope to see you in January for our 2025 market preview.